everybody. So we are here today to talk about condos, all things flood insurance. Probably one of the more complicated topics in what we do. So we definitely want to go through different types of condos and how it relates to flood insurance and hopefully answer some of your questions. So if you guys have any questions along the way, please feel free to throw them in the chat or unmute yourself and hop into the call. I am joined by my teammate, Carrie Lang, who will be helping me make sure we get those questions answered for you guys. And just so everybody knows, we always send out the materials after class, and we'll also send anything additional that corresponds with it. So we'll send out the deck today, but I also have some information around condos from the actual flood insurance manual that we'll send out. That way you have those resources handy to refer back to. So again, if you missed my introduction, my name is Courtney Gus. I'm the Director of Training here at National Flood Services. I've been doing flood insurance and insurance for a long time, but oddly enough, I'm headquartered out of sunny, snowy Columbus, Ohio. So it does flood up here, just not quite like Florida or Texas. So, but I am here to answer all your questions today. And without further ado, we will go ahead and get started. All right, and what you guys can't see is that I have an electric blanket around my lap because it is freezing here today. So today we're going to talk about condos, and there are different types of condos in what we do in flood insurance: residential, non-residential, master associations, etc. So we're going to go through some of those examples. We are going to cover the RCBAP, which is the condo association policy as a whole. So it's a big piece in what we do. It's the residential condominium building association policy. So it's a mouthful. We're also going to talk about non-residential condo coverage for those of you that write commercial business, and contents only for that as well. So a lot of the confusion around flood insurance and condo coverage is the condo unit itself versus the condo association, right? So when we're talking about the condo unit, we're talking about an individual owner or an individual unit, and that owner has interest in just the unit and the contents within that unit. But when we talk about a condo association, those are written in the name of the association. They're going to cover all the units, and their interest typically falls in the building and shared structures within the complex. So it could be the actual condo building. It could also be a clubhouse, a pool house, a shed, etc. Anything owned by the condo association would fall under that master condo policy. And there are several different types of condos out there, right? So we've seen everything from high rise to now we're seeing a lot of the single family freestanding condos. We do get a lot of questions about townhouses and row houses and how those are different from low rise condos. We talk about commercial condos a little bit, and even mobile home condo complexes. We see a lot of those in Florida. So just keep in mind that condos come in all shapes and sizes. The rules apply fairly consistently across the board once you understand those different definitions. You know what, I'll actually go through them a little bit because I think it warrants a little extra detail. So high-rise condo complexes are interesting, right? Because we're covering the entire structure, but once you get past the second or third floor, everyone's wondering why there's flood coverage. If you're on the 30th floor of a high-rise condo and you're required to carry flood insurance, there's a lot of confusion there, especially from condo unit owners as to why. Really what they're looking for, what the bank is looking for, is insurance on the structure. Because what's going to happen is if the water comes through with enough force, it can cause pretty substantial damage to the foundation of these high-rise condos. That could be millions of dollars in damage. I got muted. Can you guys hear me now? I think I accidentally got muted. Carrie, can you hear me?
Yes, sorry. I think I actually clicked you on accident, but you're good now.
Okay, thanks. If you guys want, though, you can mute me. I'm sure I get it from time to time. So on those high-rise condos, we're really looking to make sure that the building has coverage in case that foundation is damaged. Also, that shared space on the first level. Oftentimes, there's a lobby, elevators, machinery and equipment, sometimes pools, clubhouses, those kinds of things. So that's really where the coverage is used, and oftentimes kind of all sucked up when you're looking at a high-rise condo flood or flood claim. Single-family condos are a little bit different. The exterior structure is still oftentimes the responsibility of the condo association, even though they are single family freestanding condos. It's interesting because they're all freestanding. They all oftentimes have separate machinery and equipment servicing the building. They've got 4 sides, 4 separate foundations to cover. So these can be pretty costly to repair at the event of a flood. So it's something to keep in mind when you're looking at coverage for single family units. Townhouse row house can be really confusing, right? Because when we go in to do a quote for a condo policy and flood, the system's going to ask you, is it high rise or low rise? And is it a townhouse or row house? And oftentimes the question we get is, what's the difference between low rise and townhouse or row house? And the really major difference, if you read the FEMA manual and you get into the policy language, is how the units are separated. If it has a firewall or a solid wall that goes all the way from floor to roof between the units, so there's no way to get from unit A to unit B without going outside, knocking on the other person's front door and coming in, completely separated by that firewall, then it's considered a townhouse or row house, regardless of how many stories it is. So high rise or low rise. And so really, essentially, the thought is that it could be freestanding, as long as that firewall remains standing, right? So that's the difference between maybe a low rise condo that has a shared hallway versus a townhouse row house that has that firewall between the units. Commercial condos may not be something you run across very often. When I was on the insurance company side for flood insurance, oftentimes we would see these in medical buildings where the doctor's offices would actually own the unit versus a commercial structure where they're just tenants. So when I think commercial condos, I often think medical buildings, but I'm sure there are thousands of other uses for these structures. These are interesting because, and we'll talk a little bit about this at the end, but commercial structures are not treated the same way master condo policies are. They don't have the ability to take out as much coverage as a master residential condo association. So they have limited coverage compared to residential condo structures. And that could impact your commercial client. So it's definitely something to keep in mind. And then mobile homes. The only place I've ever seen a mobile home condo association is in Florida. Personally, I'm sure they're all over the country, but it's definitely something to keep in mind because there are some stipulations when you're insuring a mobile home for flood insurance, regardless of whether it's single family dwelling or as a condo form of ownership. So it has to be permanently tied down on a permanent foundation. So it cannot have wheels on it. It can't be something that can be picked up and hauled away. It does have to be permanently affixed, and we have to have the correct serial number. That's key at the time of a loss. So just keep that in mind if you're ever working with a mobile home. And if I go too fast at any time, feel free to flag me down. So the 4 methods of insuring condos fall into the RCBAP, which is on the residential side, those residential condominium building association policies. These are in the name of the association. Typically, it's coverage for the building, but occasionally if there's insurable interest in content in any of the structures, sometimes the clubhouse or gym, things like that, they may also have contents coverage. The residential unit could be both building and contents, depending on what RCBAP may already be in place. And these are really in the name of the unit owner, and the insurable interest in that unit would be on that unit owner. The non-residential building or contents coverage as a whole for the entire building. And then there's also the non-residential unit owners coverage available for those commercial unit owners. So we'll get into the residential condominium association policies. These are used when a condo association is taking out flood coverage for the entire structure. They can actually take up to $250,000 per unit times the number of units in the building. This allows the condo association to take out large amounts of coverage to cover some very large structures and hopefully meet the co-insurance requirement for these RCBAP policies. So there are a few stipulations in the flood insurance program around co-insurance, and one of them falls on these master condo policies. They have to carry at least 80% of replacement cost or that max available of $250,000 per unit in order to have the building coverage pay out at replacement cost. And that's important to note because there are some underwriting paperwork stipulations that go along with that as the agent in order to prove that they've met that co-insurance requirement. So these policies can be very, very large. And it's important to note that these policies are primary on the structure. So if you have an insured who's buying a unit and the bank says they need a flood insurance policy, time out. The first thing you're going to ask is there a master condo policy in place? Is there an RCBAP in place? Because that coverage may already be maxed out at $250,000 for their unit, and it's also going to be the primary coverage on the building policy, on the building coverage. So if it meets the bank requirement for that unit owner, they can actually provide that master condo association policy deck page to the bank to meet the bank requirement for flood. I can assure you that they are being assessed for that flood coverage in their dues because it can be very, very expensive. But it's important to keep in mind that these master condo policies exist because what happens a lot of times is we don't know there's an RCBAP in place. The unit owner goes and takes out an additional flood policy on top of it in order to, suffice for the bank, make the bank happy. And then at the time of a loss, they're stuck with this policy that has coverage. It doesn't mean it's totally worthless, but oftentimes it's very, very limited because that RCBAP is going to be that primary coverage. So make sure you're checking that first. And then the other key piece is this policy is taken out in the name of the association. And because of that, they're not taking out content for your unit owner. So it's important to note that your unit owner is going to need to make sure they take out the appropriate coverage for their own belongings. These policies must be in the name of the condo association. We do have to provide documentation showing the name of that association or how it's written. Oftentimes, we also have to provide the bylaws. That way we know exactly who's responsible for which portion of the structure. The bylaws must be up to date, and it is something that the agent is required to provide, as well as the replacement cost estimator. As the agent, we have to provide that every couple of years to make sure that we're keeping up with inflation and building cost changes, and we have the building appropriately insured. It is one policy per building. So if you have a condo community that you're working with that has multiple structures, we're going to have multiple policies. And that's important to remember as well. So that's important too when you have an insured looking for a master condo policy, make sure they get the copy of the deck page that matches their structure. I've worked on some of these accounts with agents to help them get them placed. And we've worked on everything from 3 buildings to 23 buildings. So don't be afraid of these. They can be really lucrative. They can be worth your time, but they are a little extra work. And they can be a little time consuming. So just keep that in mind. If you want to write an RCBAP, please reach out. We'd love to help you with it. Make sure that you're able to do it right the first time and it's not too cumbersome of a process. Do keep in mind as well that co-insurance piece. Oftentimes condo associations are always trying to cut costs or monitor costs in order to be efficient for their unit owners. But at the same time, there's no point in taking out coverage if it's not going to cover what they need. So we do have to make sure that they're meeting those co-insurance requirements. And if they're not, they're fully aware of what they're taking on. There are some eligibility requirements for these RCBAPs. The biggest one being it must be in a participating community that's in the regular program within the NFIP. And that just means that the city, town, village, county participates in the National Flood Insurance Program and they're in the regular program. They're not in the application process of joining the NFIP. There have to have at least 1 or more residential units. They do have to be in the name of a condo association. At least 75% of the area must be used for residential space. So we know that sometimes the first floor may have a retail space or office space, and that's fine as long as 75% of the building is used for residential purposes. We cannot use normal hotels, bed and breakfast, or motels unless they have long-term stays. And I believe the last time I read the FEMA manual, it was 6 months or more. So anytime you're looking at a long-term stay, you're really looking at almost a permanent residence or semi-permanent residence. And again, it has to have that homeowner association or condo association form of ownership. These policies cover the condominium building, some unit information or unit coverage is offered as well. So the policy can be used for units and betterments and improvements made within the unit, which is different than maybe a standard condo building policy where you're trying to determine studs out or drywall in or whatever the case is. A flood policy actually allows the master condo policy to cover internal coverages or inside the unit coverages as well. But what we often see, and I know I have some claims people on the phone, so please feel free to correct me if I'm wrong, but oftentimes the condo association just doesn't have enough money on the policy to fix the inside of everyone's unit. So oftentimes the policy may be exhausted fixing exterior damage or foundation damage, really severe pieces like that. Sometimes HVAC systems, furnaces, all of those need to be replaced for all the units. So the internal unit owner repairs fall on the actual unit owner. Additions or extensions attached to the building would also be covered. Those machinery and equipment that I mentioned would be covered. And then any contents owned by the association, as long as there's contents coverage on the policy. So if they have a workout facility, offices, clubhouse with furniture, things like that, they're going to want to make sure that they have contents coverage for those items. Like I said, there are some special underwriting requirements. I always think it's helpful to know this stuff going in as the agent so that you can collect everything on the front end. But we have to provide the replacement cost evaluation on the application. We've got to provide that documentation. So oftentimes when I work with agents in the past, you've already run the replacement cost estimator as part of the insurance package, and the flood is just an auxiliary coverage. So if you already have that run through another system, that's fine. And we have to provide that evidence, and we must update that replacement cost evaluation every 3 years. So you will receive an underwriting memo when it comes up for renewal asking you for that valuation. And if we fail to provide it, the policy will not renew, which is a huge headache, right? It took you a while to write this. It takes a lot of paperwork. So we definitely don't want to let it cancel. We want to make sure we get that replacement cost estimator in and updated. And I already mentioned this a little bit, but it is important to note that sometimes the RCBAP doesn't have enough coverage. They may have the policy completely maxed out at $250,000 per unit times the number of units in the structure, and it's still not enough. I mean, some of these condo association buildings are huge, very extravagant, very expensive materials. So it's important to note that we may be wanting to look at excess coverage for condo associations, and we're really going to be wanting to talk to our unit owner about what they're doing to cover their particular unit to try to bridge that gap.
Courtney, we got a question in the chat.
Okay.
Can a unit owner take out building coverage on their unit even if there is an RCBAP? What if the RCBAP does not have the full $250,000 and the bank is requesting buyer to purchase additional coverage?
Great questions. Yes, the unit owner can take out building coverage, even if there's an RCBAP in place. I think it's important to note, though, that when we're talking to the unit owner about that, there's no guarantee they're going to be able to use all of that building coverage. It's a nice safety net to have just in case if you need to bridge the gap. But there's no guarantee that they're going to be using any or all of that coverage, depending on how the claim shakes out, the covered items that are damaged, and the coverage that the condo association has in place. So that's definitely something we can talk about in further detail. And sometimes knowing the way the building's constructed or how the RCBAP is set up helps us further answer those questions. But that's definitely something we want to keep in mind. And if the RCBAP does not have the full $250,000 per unit, and that's what the unit owner is required to carry, then yes, the unit owner can take out the missing portion of coverage in order to meet that $250,000 requirement. It's something to know. We would just want to make sure that that matches the replacement cost estimator. Is it something where the RCBAP is underinsured and not meeting the co-insurance requirement? Or is it just something where that unit happens to be more expensive and they have to take out additional coverage? We just want to make sure they're not overpaying, but at the same time, sometimes the bank requires it and we don't have a choice and we can take out that additional coverage as well. Again, no guarantee they're going to get to use it, but at least it meets the bank requirement and they can close on the loan. Great question. Oh, and I missed another one, didn't I?
That was all in the main chat, unless you got one. Oh, there it
I
is.
got
Can the RCBAP be forced?
Okay, so I got a question about, okay, so I'm going to read this question, everybody, so everybody can hear it, because I think it's a really good question. She's asking about how the master condo policy and the individual unit owner policies mesh. When there's a master policy, does it cover additions and alterations for an individual unit? Would an individual unit have to buy dwelling coverage for the additions and extensions, or would it not apply? Should a unit owner buy contents only? All really great questions. So the unit owner, the master condo policy does cover or does leave coverage for additions and extensions or additions and alterations made to a unit. It's actually listed in the manual that they can use a portion of the coverage for that. But like I said before, sometimes the condo association policy doesn't have enough coverage to make those repairs on every single unit that's damaged. So they may only get some or none of that additional coverage paid out for their individual unit. The unit owner can take out building coverage on their unit, but it's all going to depend on how the bylaws state who's responsible for which portion of the building. So if it's an addition and alteration or alteration and extension that technically the condo association is responsible for in terms of the insurable interest, the unit owner may not be able to use building coverage for that, but they can use up to 10% of their contents coverage for betterments and improvements they've made to the unit. So if they have 100,000 in contents coverage, they can use $10,000 for betterments and improvements they've made to the unit if there's no other coverage afforded from the RCBAP. So that's something to keep in mind as well. So yes, the unit owner should buy contents coverage, and they can use it for betterments and improvements along with their contents coverage. If they use 10% for those improvements, it's actually going to deduct from their $100,000 in coverage. So now they'll only have 90,000 left for the remaining contents damage. I hope that helps. I know it's not necessarily going to make a condo unit owner whole again, depending on the damage sustained, if it's cabinets and flooring and it's something that the RCBAP can't cover, but it will afford them some coverage, so hopefully they can get back on their feet. Condo ownership and bylaws can be so tricky. Sometimes it helps tremendously to get, at the time of a loss, to get the unit owner adjuster and the RCBAP adjuster aligned so that we can maximize all the coverages that are available to the insured. So they can work together to see which policy is responsible for each portion of coverage. We've had it where we've had conference calls where everybody's on together, or on site where we've received recaps later where they've worked together, because sometimes it really depends on exactly what was damaged and who's responsible for it. All right. Oh, and I got a thanks. So hopefully I'm glad that answered your question. And if you guys ever have one-off situations where you want us to take a quick look at something or you're confused, please let us know. Our claims team is absolutely phenomenal and very experienced. And we send them all kinds of hypothetical stuff. We try to keep it, reasonable, but they're able to help us just to make sure that we're getting the right coverages in place.
Courtney, there was one more question in the main chat. Can the RCBAP be forced to take out additional coverage?
I wouldn't, unless the condo association has a loan in the name of the association. I don't know that they would be forced to take out additional coverage. The only other scenario there may be if the condo association bylaws state that the condo association is required to carry replacement cost coverage or as close to it as possible. There's no stipulation in the Mortgage Portfolio Protection Act, which is where the bank requirement for flood comes in, that if there's not a loan involved, I don't know how the bank could force the condo association to carry additional coverage. Now, as a unit owner, if my condo association doesn't have enough coverage out on my unit and I'm being assessed for that, I would be very vocal resident in making sure that they have the appropriate coverage, because I wouldn't want my coverage to be paid out at actual cash value when I know that there's this replacement cost opportunity out there. So I think that's an education piece for agents and condo associations, because I think if unit owners knew that the association didn't have the appropriate coverages, they would probably be a lot more involved in the process. Because nobody wants to be assessed when they could have had the coverage on the front end. All right. So we're going to get into unit owners. And again, we're just talking about how these mesh together, right? So the RCBAP's in place, it's primary. Depending on the amount of coverage taken out by the RCBAP, it's going to dictate what our unit owners can do. So we want to make sure that we get a copy of that master condo policy so that we can see what kind of options we have for our unit owners. So first thing, get that RCBAP. Then let's figure out what kind of coverage our unit owner needs, especially if they're on one of those low-level condos, first floor, second floor, townhouse, row house. Want to make sure they for sure have contents, because nobody wants contents coverage until they lose all their contents. But it also gives them that additional coverage for betterments and improvements. And there's a stipulation on a unit owner policy that also may help them cover any assessments from the condo association. And we'll get into that in just a minute. But keep in mind, unit owners can get contents coverage for sure. And depending on how their bylaws are written and how much coverage is already taken out on the RCBAP, they may want to take out a little bit of building coverage as well. I got another question. When quoting residential flood insurance and the dwelling type is entered as condo, 200,000 building coverage, no coverage. Okay, so the question is even though the system will let you quote $100,000 on building coverage for a condo unit, does that mean there's actually no coverage? And like I said before, it's a great question. Not necessarily. It really depends on how that master condo policy is written and how much coverage that unit needs. There may be an opportunity there where there's a gap, and your insurance policy may kick in as secondary coverage in that case. And then it may also work down the road as assessment coverage. So keep that in mind. I wish there was a one size fits all answer, but the first thing to do is pull out that RCBAP, see how much coverage is already on the unit, and then let's figure out where the gaps may be so that we can work through those.
Brittany, we got another question. I can let you get a sip of water if you need a break. You're doing awesome with all
Fire
this.
away at those questions. We knew this was going to be a busy class.
It is. All right. So if the unit owner has $1 million in additions and alterations, if they purchase the building coverage, would it pay in addition to the association coverage of the $250,000 per unit?
No, but I wish I lived in a condo that had that much upgrades, right? $1 million, is that what you said?
Yeah, yep.
Oh, I'm super jealous. Okay. So no, the max FEMA will ever pay out on one unit is $250,000 in building coverage. So if the RCBAP exhausts that limit, there will be no additional coverage afforded on that underlying NFIP policy. If you have that high value of a unit, you're going to want to look at an excess flood policy that would layer on top of that RCBAP. Those excess policies are available. Sometimes they even have additional coverages in there. The excess markets are really great at adding things in like loss of use or replacement cost coverage for contents, things like that. They are going to want a copy of that underlying policy to prove that the underlying policy coverage is in place. And they are going to renew every year, just like excess and surplus lines policies. But they are out there. They are 100% available. And anytime you're working with a high value condo or home like that, I highly recommend you at least get it quoted and have the insured sign off if they choose not to take it, because they will be short quite a bit of money at the time of a loss. And when we send you guys out the materials in the NFIP manual, specifically around master condo associations versus condo units, responsibilities and coverages, there's a very clear chart in there to help you walk through the differences between the two. And I've had several agents reach out specifically for this section of the manual, because when they're working with high value condo owners, there's oftentimes misconceptions around who's responsible for which portion of the coverage and how much is available, and that the $250,000 is it for the unit. And so sometimes they like to send that to the customer so that they understand that this is set in stone, these limits apply. So I will make sure, Carrie's phenomenal about following up after these classes. You guys will all get a copy of that. And if you have any questions, please feel free to let us know. But I think it's handy to keep on file. Unit owners coverage does cover the building elements, depending on the ownership piece. We want to make sure we're looking at those bylaws, as well as the contents. That's probably the key piece. 10% of the contents coverage can be used for betterments and improvements, like we've discussed. And that unit owner's coverage is going to be heavily dependent on what's already in place in the RCBAP. So just make sure that we're checking that RCBAP and that the customer understands that some of the coverage is owned by the condo association and some of that coverage is going to be owned by them as the unit owner. There is a really cool feature on a unit owner's flood policy that isn't found, I don't think, in very many types of insurance, and that's assessment coverage. So if for whatever reason the condo association assesses the unit owner for additional money related to a flood loss, specifically to a flood loss, their policy can actually kick in and help them cover a portion of that assessment. It is important to note that it can't be used to cover the deductible for the RCBAP for the master condo policy. Those deductibles can be upwards of $50,000. We cannot cover the assessment for that deductible. We also cannot cover an assessment caused by a co-insurance penalty. So if the RCBAP fails to carry enough coverage and they assess the unit owners, which is exactly what would happen in that case, we are unable to use the assessment coverage for that, as well as any coverage that's in excess of coverage already paid. So if the $250,000 per unit has been completely maxed out and then they assess the unit owners, we're not allowed to pay for that assessment either out of the flood policy, because again, the most FEMA's ever going to pay for a single dwelling unit is $250,000. But it may help them cover the share of a loss if for whatever reason it doesn't, it's not part of those. Maybe the policy's exhausted at $170,000 per unit, and there's additional coverage that's assessed to the unit owners. At that point, the customer's policy would kick in and help them pay for some of that assessment coverage. So it's a neat feature, especially for these large associations that may not have enough coverage. And it's important to note that a flood policy is only going to be for certain items, right? We all know as agents that flood policies don't cover every single item in a structure. So sometimes there are items that are damaged that aren't part of the flood policy repair. So it's important to keep that in mind. We did give a quick breakdown of commonly covered items versus on the RCBAP versus the unit owner. And you can see here, appliances in the kitchens and things like that, plumbing fixtures, hot water tanks, air conditioning units. Those are all things actually covered by the RCBAP, along with things that we would already think of, like the foundation, doors, windows, structure, things like that. So keep in mind that the coverage is actually a little bit broader than maybe we might be thinking. And then over on the dwelling unit, you can see here that insurable building items not already covered by the RCBAP would fall here, personal property items, and 10% of betterments and improvements. You can actually get a great list out of the NFIP manual here as well, but we just wanted to give you kind of an overview of what we're talking about, just so that you had a kind of a frame of reference on this. And then we'll get into non-residential condos. But before I switch to that, does anybody have any, and we'll have time at the end for additional questions, but does anybody have any other residential condo unit questions? Okay, we spend a lot of time on condo units in our world, so please feel free to throw any questions out. We know it can be really confusing. So when you're talking about non-residential condos, it's completely different than the residential side. And really that's because they're treated like any other commercial structure. It's a max of $500,000 for the building. They don't get $500,000 per unit times the number of units in the building like you would on the residential side. It's just the $500,000 for the building. So coverage can be incredibly limited. And depending on the condo unit owner, they may be short some coverage and really need to be looking at excess coverages in that case. Again, these oftentimes are medical facilities, medical offices. That's at least the only ones I ever seem to run across. But again, I'm sure there's other commercial condo unit ownership formats out there. And oftentimes it's building coverage that's required as part of that condo association. But the bank may require a non-residential condo unit owner to carry contents as part of the loan. What I always ran into is those non-residential condo unit owners, again, often medical offices, use the medical equipment as collateral on the loan. Expensive medical equipment, right? Like MRI machines and all kinds of things I learned about doing flood insurance. So sometimes building coverage is required, and sometimes contents coverage is actually required on the non-residential side, which is something to keep in mind when you're working with non-residential condos. I got it really. Yeah, did you see that question?
Yep.
You can go ahead and read it. It's interesting.
Yeah. So, could excess coverage cover the additional assessment fees?
That's a great question. I just want to touch on this real quick because it goes back to our excess conversation and the assessments coverage. It's going to depend on the market. Every single excess market, most of them are Lloyd's backed, excess and surplus line syndicates. They're all going to have slightly different coverages, whether it's assessment fees, replacement cost coverages, specialized inland marine or loss of use coverages. It's really going to depend on the market you choose and the coverages you select. Also the risk. There may be some items there, those E&S markets are not willing to cover based on the risks. That's a great question. It's definitely going to be market dependent. Okay, so back to non-residential condo association. So again, it's going to be very similar to the residential side, other than that main coverage piece. So it's going to have to be in the name of the condo association. The insured building and commonly owned contents can be what's covered on the policy. Non-residential limits apply. So again, we're capped at that $500,000 for the whole building, which oftentimes we know on the agency side is only going to cover the first floor. So something to keep in mind. And it is ACV for building and contents. So non-residential flood is always going to pay out ACV, regardless of the amount of coverage the insured carries. It's not like the residential side where they have the opportunity to meet a co-insurance amount or limit. So it's important to keep in mind that commercial flood is always going to pay out ACV for building and contents. If you have an insured who needs additional coverage, this is a prime opportunity for excess coverage because commercial structures can be in the tens of hundreds of millions, depending on the size of these structures. And our little $500,000 policy is going to leave them very exposed. And then the same with the unit owner. They, depending on the way the bylaws are written, are most likely only going to be responsible for the contents of that structure. If we're already maxed out on the building, there could be little to no use for building coverage on their unit owner policy. They may still want to carry a little bit, but ultimately it's the contents that they are going to want to be covering, and they can actually get up to $500,000 in contents. So it's just like a normal non-residential policy. They get quite a bit more contents than the residential side, but they are going to pay out ACV. So it's important to note, and again, sometimes you will run across where the bank is actually requiring contents coverage as part of the loan. So if that's the case, we can waive the 30-day wait just like we can for any other loan transaction. But it's unusual when the bank requires content. So just something to keep in mind. These are issued on the general property form. You can do contents coverage only. This is saying building coverage is not available. It's true. You're not going to, you're almost always never going to write building coverage on the non-residential side because those policy limits are so low and they typically don't have any insurable interest in the building. The coverage is up to $500,000 under the name of the personal unit owner, and they can use up to 10% for betterments and improvements made to the unit. So if they've made improvements to their unit as part of their business, they can absolutely use 10% for those betterments and improvements. And again, talk excess, speak excess, and document. And at the end of the day, I just spent almost 45 minutes talking about condos, just condos and flood. We're trying to break these topics down into smaller, easier to understand tidbits. So hopefully you guys found that helpful. But at the end of the day, we have lots of resources on our website. Please sign up for future webinars and feel free to email us or call us with questions anytime. Reach out to the insurance company that you work with, our WIO partners, with questions as well. They're a wealth of information. And keep an eye out if you guys, we will have elevation certificates next week, as well as a really exciting new webinar around virtual adjusting, which is kind of the wave of the future, given everything with COVID and technology. So please join us for that next week. And I'm here for questions, Carrie.
That was awesome, Courtney. We don't have anything coming through just yet, but as Courtney mentioned, now's the time. I know she did awesome answering throughout, but if anyone has anything else, or you can always reach out to us via email. When I send the materials, I'll include all our contact information as well. Big thank yous, big thank yous. Joanne, I'm not sure if you knew that this was sent just privately to me, but she gave you a big thank you. Excellent information. It was very informative, and she's looking forward to future webinars.
Good, thanks.
Yeah.
Makes my day. Well, I'll hang out for a few extra minutes if anybody has anything. Again, otherwise, like Carrie said, you guys will have all of our contact information very soon. And I do look forward to seeing you on future webinars for sure. Oh, thanks, Sandra. Thanks, guys.
We also love any feedback. If there's any topics that anyone can, oh, 2 pages of notes. That's awesome. Me too. If there's any feedback or topics that you're really not sure of and you'd like us to make a webinar out of it, please let us know. We're totally open to anything that anyone's struggling with or has more questions about.
I'm so glad this was so helpful. This is one of the most confusing topics for me as well. So we're always learning. So, oh, you guys are so great. Thank you so much. Oh, good. And Sandra, if you missed anything, we'll be sure to send out all the resources too. But I love that you were using your snipping tool.
And this, we'll also put the recorded version. It takes a couple of days, but we'll have this exact version of Courtney's presentation on the National Flood Services website.
All right. Well, if there's no further questions, early dismissal for the group. Hope you guys all have a wonderful afternoon wherever you are. Hopefully it's warmer than here. And we will see you all soon. Thank you.